Welcome back to the channel. I've just come back from the gym, so I'm obviously in gym wear, and today we're going to be talking about my portfolio and exactly why I'm not allowed to buy stocks. Now, lately I've been really focusing on the value of the content. I think if I'm learning some good lessons here, or if I'm able to at least share these lessons with you, then please drop one of these to help beat that YouTube algorithm, as it is much appreciated. So why am I not allowed to buy stocks? Well, I think firstly we really need to look at my portfolio to understand why. And on my portfolio here, we can see that I have got quite a significant downtrend in my portfolio. I'm down overall 56% in 942 days. Now, this has been recovering and has been slowly improving over the last few weeks, but again, this could furthermore drop. Now, you might go, okay, why did this happen? Well, one of the mistakes were the fact that I was overexposed to one or two stocks. Fair enough, but there's a bigger lesson to this. Was it the fear of missing out? Was it buying these companies at a price that I felt was, a bargain and going, oh no, I'm seeing the shares fall. Oh wait, everyone's jumping on it. I'm going to jump in. Was it the fear of missing out? No. Actually, what I've learned, and this is going to be new here because I haven't said this before, and it's because I've been deluding myself, right? And it's actually valuations. It's taking into account the actual value of the company and finding a fair price and setting subsequently target prices from this. Now you might go, what you on about? You've always said this. I might have said it, but I've never actually taken action on it. So therefore, I've created a new rule that means I am not allowed to buy a single share of a stock until I have effectively valued them. And this means I need to set my own target prices. And by setting the target prices, it means I can be more disciplined with my cash in my portfolio. It means that I'm not going to become, or I'm less likely to become, overexposed to one stock, and I'm going to wait until I think a good opportunity is present. That said, I think in my head at the moment, I haven't done these target pricings. I've been trying, expanding upon ideas here. I'm going to be sharing them with you. That said, at the moment, I do think the holdings I have value, but I want to be able to see this in numerical format. So I have been running a lot of the numbers here. You can see the piece of paper, it's full to the brim, a lot of stuff here. And I've been looking at things such as the net worth of the business. Just simply looking at, okay, what's the debt, what's the equity, and what's the cash? Okay, what's the equity plus the cash minus the debt? Are they in a positive net worth? Okay, that's a good sign to see, but it doesn't really give me any form of a value. Well, what about enterprise value, right? The idea of adding the market capitalization and the debt together and then minusing the cash over this. And obviously in the case of Boohoo, for instance, I believe they had an EV or an enterprise value. I can't even see it right here. But basically it was about 5. It was pretty much the market cap because their debt and their cash was pretty much cancelled out. But again, what do you compare enterprise value to? In the past, I've used EBITDA, and I don't think that is too good of a metric because, again, you need to have good examples, good comparisons. The whole reason why price to earnings ratios are so easy to use is because it's such a commonly coined term, right? You know that the average market PE historically is between 15 to 17 times price to earnings. However, when you go for more into deeper, more advanced metrics like EV to EBITDA, you're then looking at a little bit more niche studies, and you're looking at these things that are less proven. And you've seen investors that don't even delve into this level of depth. You're not even getting into the likes of discounted cash flows, and you go, is it truly needed in the investment strategy? So what can we do to effectively value a business and therefore set good target prices? Well, I really think the most success I've found, or at least what I've in developing a target price at the moment, is not only identifying the market average and seeing that mean reversion. So if you buy a stock with a price to earnings ratio of 5 times and the market that it's in is the 15 times average over the longer term, we would likely over a longer period of time, dependent on the company obviously, probably see that lower PE ratio stock slowly revert to the mean, being the middle there, well that's the median, but reverting towards the average, which is 15 times. There is likely a reason why it'd be trading at 5 times earnings, and it may never touch 15 times earnings, but it may push up slightly. However, I think more important than that is price to earnings growth. Now, this can be exchanged, and I think here this has become one of my criteria for holding a stock. If you don't have earnings in the business and the business is currently unprofitable, like my biggest holding with Boohoo, then I think free cash flow can be taken into account. I think that is a fair metric to use as well. Unarguably, I'd probably use free cash flow over earnings in general, but I think it's good to see both and see how they perform. Ideally here, and this is what Peter Lynch uses in his strategy, is that you don't really, or a fair value of a business is a price to earnings growth ratio of 1. What does that mean? Well, if you've got a price to earnings ratio of 20 times, but the company is expected to carry on growing their earnings at a rate of 20% per year, then this is a price to earnings growth rate of 1, not 11. I know I put 2 fingers up there. Sometimes I'm just not with it, you can tell. And here we are. So we've got this idea that the fair value there is a 20 times PE ratio for a 20% annual earnings growth. Now, of course, this is hard to predict, and I don't trust analyst judgments at all. They focus very much on the short term, and they might do all of these fancy numbers and that, but again, I think ultimately you need to be able to run these numbers yourself. And I always think in this situation, it's always good to be conservative. Why not say that Boohoo's they might be forecasting in the medium term to be getting 15% earnings growth, right? I think they even said that about revenue and not earnings. So let's just say that. Well, if they've said that by the company, and maybe they have had a good track record previously, pre-pandemic, well, what about if we take that down a bit? What if we say, okay, what if Boohoo has a 10% earnings growth per year? Do we think this is achievable? Do you think this is possible? And in the case of Boohoo, they don't have any earnings at the moment, so we'll look at cash flow. Is this achievable? Okay, the cash flow is also negative. Well, let's go back to 2018, pre-pandemic, see the numbers and go, do we think this is achievable? Do you think that growth can be done? If so, then there might be a good price value here that you might find effective. And I think I did run the numbers on Boohoo, and I felt here that at 2018's earnings times by a price to earnings ratio of 8.8 times. I did this by looking at the current UK market average, which was around about 11 times, and then just doing a 20% discount on that. So I got to a number of about 8.8 times. I times that by the earnings, obviously, that they had in 2018, which was quite a low figure. And I found that the market capitalization at that point with what it would be is £341 million, which is about 55% of what it is today. And that's looking at 2018 earnings and timesing it by a very, very moderate price to earnings ratio. In that situation, if they were expected to grow their annual earnings by 10% per year and they were trading at an 8.8 times price to earnings ratio, then that seems like a good deal in my opinion. That, at that point, would make it a price target of about 27 and a half pence, which is very low, I think, from the current price. And I think that's a very pessimistic outlook. But again, I think you've got to be quite conservative. I think the more greedy you are of your price targets, as long as you have investments in the markets already and you've just got a cash pile that you're building, I think you can afford to be greedy. You're not going to lose too much by being outside of the markets here. There's no rush. But knowing that you've got 50 quality companies that you've narrowed down and you know exactly what to look for, and that you're just, waiting for them to hit those certain price targets and following them, then that seems like a good strategy to me. Knowing that, okay, look, Boohoo, they might be trading at £1.20 a share, right? And I've done a fair valuation. I've said that they're worth 56 pence a share. Now, at the moment, because they're £1.20 a share, I'm not going to look at it. I'm not going to buy it. I'm going to follow the results, see how they're doing. Okay, sure, I might miss out on some of the gains. I'll readjust my target price as their earnings grow. But then there might be a downturn. There might be a year or two bear market, and in that time the share price has tanked all the way from £1.40 a share down to 40 pence, and at that point I can go, you know what, look, it's below 56 pence a share here. I'm going to start buying here. I'm going to start adding to this position and really building up a significant stake. And I think that's really the importance of having price targets here, and I think there are so many ways to do it that it's very, very difficult to do this. And so what I'm trying to build at the moment is like a 10 things that must, or 10 criteria that must be available when purchasing a stock. And I've only got 5 of them so far, but I think they are very specific, and I think they will help narrow down bad investments. One of them I'm going to share with you just now is that if a company is currently unprofitable, I believe that they should have been profitable within the last 5 years. Then you can justify using a free cash flow metric in that time period. Now you might go, okay, but why does the company have to be profitable in the last 5 years? What about all these growth stocks that aren't profitable ever? I want to know that a company is able to return shareholder value by growing their earnings, right? And of course, this is going to be at a slightly lower risk here compared to those that are unprofitable. But in this situation, if the company is able to grow their earnings, or in the past 5 years has at least shown that they know how to be profitable, then they know that they could probably streamline the business, or they know what they need to achieve in order to become profitable once more. And I'll tell you what, as a bonus here, I'm also going to be looking at something else. And another criteria I have is that I like to see companies with a gross margin of above 45%. I think 45 to 50 is a good amount. I would ideally like higher. Games Workshop, for instance, is about 69%. I know that's very nice, and I think that's good here. So setting a price target and then going, okay, what are the criteria? Okay, well, I've got a price target of, let's say, Rio Tinto. Let's say it's £42 a share. Well, actually, no. Well, they have been profitable in the last 5 years. That's great. But hang on this other criteria here, they're not a buy because they don't have any good long-term incentive plans, which I think isn't good for, management's alignment with shareholders following the principal agent theory. Anyway, thank you for watching. Have a fantastic day.